Hi, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets so you make better decisions in your business and with your investments. Let's start with the highlights. Markets have been broadly higher this year, with stocks and bonds both delivering strong returns. That strength is underpinned by earnings growth and a revived IPO market. Economic growth continues, but it's uneven. Consumers and businesses are keeping things moving even as the pace moderates. And finally, this is a bifurcated economy. AI-driven investment is booming, while tariff-impacted sectors and stretched households are feeling the pressure. Now, let's take a deeper look at the data, see what else we can learn. The market performance has been strong, with stock markets broadly higher in September and for the quarter. For the year, international continues to outperform U.S. markets, though many U.S. markets are hitting all-time highs. Bonds have continued their rally, up between 2 to 3% for the quarter and 6 to 7% for the year. Bitcoin continues its march higher, up nearly 6% in September and 23% year-to-date. Commodities have been the soft spot, down for the quarter, with oil down nearly 13% for the year. Earnings growth is the real driver here. AI companies, which are here in orange, that have seen the most consistent revision upwards of earnings expectations. And it's not just big tech. Since the summer, we're also seeing small and mid-sized companies beating expectations and showing real earnings power. Now, another important development is the Fed. After holding rates steady for some time, the Fed has now made its first cut of 2025, and that marks a turning point, signaling that policymakers are more concerned about weaker labor markets than inflation right now. Markets are also looking ahead. Investors expect 2 more rate cuts this year, and then roughly 1 per quarter through the first half of 2026. That means financial conditions should gradually become more supportive for both businesses and for consumers. We're also seeing investors shift into more discretionary stocks and away from defensive staples. What originally started this summer, once tariff impacts became more clear, has accelerated with expectations of the Fed reducing rates. The IPO market is another sign of that confidence. After being quiet for several years, new public offerings are surging again, up 50% year on year. Several big IPOs have performed well, and according to investment bankers, the pipeline continues to fill up. Credit markets tell the same story. Spreads, which is the extra yield that investors demand to hold corporate bonds, are near historic lows, and that means that companies can borrow cheaply and investors remain eager to take on that credit risk. Now, turning to the economy, real-time data, like the Atlanta Fed's GDP Now estimate, has been trending higher since midsummer. Now, growth is not spectacular, but underlying economic data is moving in the right direction. Despite that, consumers remain cautious. We've talked about this trend the last few years, of this difference between actions and feelings in economic data. Consumer optimism surveys are still well below historical averages. So while people are spending, they're not feeling great about the economy. And that unease could affect behavior going forward. That unease shows up in spending data. After a strong surge around July's Prime Day, growth in consumer spending has slowed down noticeably. Households are being more selective, stronger for essentials and higher income spending, weaker for discretionary. We're starting to see the tariff impact in spending. Furniture, clothing, electronics are all showing falling momentum, while categories less exposed to tariffs remain steadier. Now, this is where lower and middle income households are really feeling the squeeze. And that pressure shows up in the job market too. Industries directly impacted by tariffs are shedding jobs, while non-impacted industries are still hanging on. It's another example of how bifurcated this economy has become. At the same time, investment in data centers, largely tied to artificial intelligence, has surged so much that it's now contributing as much to GDP growth as household spending. This marks a major shift in what's driving the U.S. economy. To sum up everything from today, here are the key takeaways. Markets have been strong, with stock and bonds both delivering gains. Earnings growth and a revival in IPO activity show investors are confident again. The economy is still expanding, but growth is uneven and moderating, and we're seeing a clear divide. AI-driven investment and higher income spending remain strong, while tariff-impacted sectors and stretched households face headwinds. With that, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time with our next edition of The Pulse.